Hello everyone. My today's topic is working capital management. Let's know what is the meaning of working capital. Working capital typically means the firm's holding of current or short-term assets such as cash, receivables, inventory and marketable securities. These items are also referred to as the circulating capital. And if we talk about the definition of the working capital, it is here working capital refers to that part of the firm's capital which is required for financing short-term or current assets such as cash, marketable securities, debtors and inventories. If we discuss the concept of working capital, we can interpret into two ways. One is the balance sheet concept, second is the operating cycle concept. Let's discuss the first one, that is the balance sheet concept. There are two interpretations of working capital under the balance sheet concept. One is the net working capital, second one is the gross working capital. Gross working capital. In the broad sense, the term working capital refers to the gross working capital. It refers to the capital invested in total current assets of the enterprise. And when we discuss about the second concept, that is a net working capital, it is a narrow concept. In this, the term working capital refers to the net working capital when the excess of current assets is there over the current liabilities. Let's have a look on what are the current assets. Current assets may include cash in hand, bank balances, bills receivable, sundry debtors, short-term loans, advances, inventories. It may include raw material, work in progress, stores, spares and finished goods. Next, the temporary investment of surplus funds, and next is prepaid expenses and accrued incomes. If we talk about the current liabilities, it may be bills payable, sundry creditors or accounts payable, accrued or outstanding expenses, short-term loans, advances, deposits, dividends payable, bank overdraft and provision for tax if it doesn't amount to appropriation of profits. The next concept in working capital is the operating cycle concept. What is operating cycle concept? A company's operating cycle typically consists of three primary activities. One is purchasing resources, second is producing the product, and third one is distributing the product. The operating cycle of any company starts with the purchase of raw material, then it moves for work in progress. Work in progress definitely add value to it. Then work in progress shifts to finished goods. Finished goods are moved for sale and sale in terms get the accounts receivable in cash and again it amounts for accounts payable and the process again starts with the raw material and this process goes on and we call it as the working capital cycle or the operating cycle. The gross operating cycle of company is a composite of four factors. RMCP, that is raw material conversion period, that how much time it takes to convert the raw material. Second is WIPCP, that is work in progress conversion period. FGCP, finished goods conversion period, and last one is the RCP, that is receivables conversion period. The total of all these four components give the rise to the term gross operating cycle. The next topic for discussion here is the type of working capital. It can be divided on two bases, that is basis of concept and basis of time. The basis of concept we have already discussed, that is the gross working capital and the net working capital. Next, let's discuss on the basis of time. On the basis of time, the working capital can be divided into permanent or fixed working capital, temporary or variable working capital. If we discuss the permanent or fixed working capital, this further can be classified into regular working capital and reserve work capital. Now, what is the permanent or fixed working capital? A part of the investment in current assets is as permanent as the investment in fixed assets. It covers the minimum amount necessary for maintaining the circulation of the current assets. Working capital invested in the circulation of the current assets and keeping it moving is permanently locked up. It is of two types, regular working capital and the reserve margin or cushion working capital. Now what is this? Regular working capital, it is a minimum amount of liquid capital required to keep up the circulation of the capital from cash to inventories to receivables and back again to cash. This would include a sufficient amount of cash to maintain reasonable quantities of raw material for processing into finished goods or to ensure quick delivery. And what is the second one? That is the reserve margin or cushion working capital. It is extra capital required to meet unforeseen contingencies that may arise in future. These contingencies may crop up on account of rise in prices, business depressions, strikes, lockouts, fires or any unexpected competition. It is needed over and above the regular working capital requirements. The next is the variable working capital. What is variable working capital? The variable working capital fluctuates with the volume of the business. It may be divided into seasonal and special working capital. Let's explain these two concepts. What is seasonal working capital? It refers to liquid capital needed during the particular season. According to Jensenberg, beyond initial and regular working capital, most businesses will require at stated intervals a large amount of current assets to fill the demand of the seasonal busy periods. This is called the seasonal working capital. During the seasons, the business enterprises have to push up purchase of raw material. For example, sugarcane by sugar mills, wool by woolen mills, and employ more and more people to convert them into the finished goods, and these thus requires large amount of working capital, and this leads to the seasonal working capital. And next concept is special working capital. It is that part of variable capital which is needed for financial special operations such as the organization of special campaigns for increasing sales through advertisement or other sale promotion activities, for conducting research experiments or execution of special orders of government that will have to be financed by additional working capital. Now, what is the difference between the permanent capital and the variable working capital? The distinction between both is important in arranging the finance for an enterprise. Permanent working capital should be raised in the same way as fixed capital is procured. As we can clearly see in this diagram, the permanent working capital is constant over the period of time, whereas the variable working capital is increasing or decreasing as per the demand of various times. Now the question arises, how much working capital is the adequate one? It should not be in excess or it should not be in shortage. Every business concern should have adequate working capital to run its business operations. It should have neither redundant or excess working capital nor inadequate or shortage of working capital. Both excess as well as the shortage of working capital situations are bad for any business. However, out of two, inadequacy or shortage of working capital is more dangerous from the point of view of the firm. Next is, what are the disadvantages of redundant or excess working capital? Why the firm should not have the excess working capital? This leads to idle funds, non-profitable for business. It leads to poor rate of return, rate of investment, return on investment, unnecessary purchasing and accumulation of inventories over required level, excessive debtors and defective credit policies, higher incidence of bad debts, overall inefficiencies in the organization. When there is excessive working capital, credit worthiness also suffers. Due to low rate of return on investments, the market value of shares may fall. So these are the reasons that any company should not have the excess working capital. Now it's opposite. What are the disadvantages or dangers of inadequate or short working capital? It is more dangerous. In case of short working capital, you can't pay off the short-term liabilities in time. Economies of scale are not possible. There is a difficulty for the firm to exploit favorable market situations. Day-to-day liquidity situations warrants improper utilization of the fixed assets and rate of return on assets falls sharply. The next I am going to discuss here is factors determining the working capital requirements. The first factor is nature or character of business. The working capital requirements of a firm basically depends upon the nature of its business. Public utility undertakings like electricity, water supply and railways need very limited working capital because they offer cash sales only and supply services, not the products. So they need very less amount of working capital. Opposite to it, the trading and the financial firm require less investment in fixed assets but have to invest large amount in current assets like inventories, receivables and cash. As they need large amount of working capital, so the manufacturing undertakings also require sizable working capital along with the fixed investments. That means it is the nature of the business which decides what amount of working capital is required. The second factor is size of the business. The working capital requirements of a concern are directly influenced by the size of its business. If greater the size, large amount of working capital is needed and vice versa. The third point is production policy. In certain industries, the demand is subject to wide fluctuations due to seasonal variations. The requirements of working capital in such cases depends upon the production policy. The production could be kept either steady by accumulating inventories during slack periods with a view to meet high demand during the peak seasons, or the production could be curtailed during the slack season and increased during the peak season. The next is the length of the production cycle. In manufacturing businesses, the requirement of working capital increase in direct proportion to length of manufacturing process. Longer the process period of manufacture, larger the amount of working capital is required. Next is seasonal variations. In certain industries, raw material is not available throughout the year. They have to buy raw material in bulk during the season to ensure an uninterrupted flow and process them during the entire year. So the time period in which they purchase the raw material, a larger amount of working capital is required. Next is working capital cycle. In a manufacturing concern, the working capital cycle starts with the purchase of raw material and ends with the realization of cash from the sale of finished product. So this way, this cycle involves purchase of raw material, its conversion into stock of finished goods, as I have already explained this cycle. So what is the length of the operating cycle will determine the amount of the working capital needed. Next is rate of stock turnover. There is a high degree of inverse correlationship between the quantum of working capital and the velocity or speed with which the sales are effected. A firm having a high rate of stock turnover will need definitely a lower amount of working capital and vice versa. Next point is credit policy. The credit policy of a concern in its dealing with debtors and creditors influence considerably the requirements of working capital. A concern that purchases its requirements on credit and sells its products on cash requires lesser amount of working capital. On the other hand, a concern buying its requirements for cash and allowing credit to its customers shall need larger amount of working capital. Next point may be business cycles. Business cycle, what are business cycle? Business cycle refers to alternate expansion and contraction in general business activities. In a period of boom, when the business is prosperous, there is a larger need of working capital due to increase in sale, rise in prices, optimistic expansion of business, etc. On its contrary, when there is a period of depression, we need less working capital. Rate of growth of business. The working capital requirements of a concern increase with the growth and expansion of its business activities. Although it is difficult to determine the relationship between the growth in the volume of business and growth in the working capital of a business, yet it may be concluded that for normal rate of expansion in the volume of business, we may have retained profits to provide for more working capital, but in fast growing concerns, we shall require larger amount of working capital. The next factor I am covering here is earning capacity and dividend policy. Some firms have more earning capacity than others due to the quality of their products, monopoly conditions, etc. A firm that maintains a steady high rate of cash dividend, irrespective of its generation of profits, needs more working capital than the firm that retains larger part of its profits and doesn't pay so high rate of cash dividends. Next point is price level changes. Changes in the price level also affect the working capital requirements. Generally, the rising prices will require the firm to maintain larger amount of working capital. as more funds will be required to maintain the same current assets. The effect of rising prices may be different for different firms. Some firms may be affected much, while some others may not be affected at all by rise in the prices. And there are many more factors like operating efficiency, management ability, irregularities of supply, import policies, asset structure, etc., which also influence the requirements of the working capital of a company. I am winding up the topic here. Thank you so much.